and welcome to the CNBC Africa exclusive. I'm Nozipho, Mbanjwa. We're coming to you from Nairobi, Kenya, where we're sitting down with the Vice President and Treasurer at the IFC Jingdong Hua, who's going to be talking to us about the significance of the conversation that is happening here in East Africa. The focus is on the development of capital markets, not only for Kenya, not only for the region, but certainly for the continent at large. Thank you so much for making the time to join us.
Nozi, it's my pleasure. This is truly exciting times. It is exciting because the global community has come together and recognize that we need to make a concerted effort to achieve the SDG. Now, to do that, private sector has to be central because private sector creates over 90% of all the jobs. Now, how do you create an environment where private sector entrepreneurs will thrive and get the level of financing that is needed? In that setting, capital market comes in. So if I could go back to the year 1990, and that was the year I left China. And you know, at that time, China was still very much a closed country and starting to open up. But if you were to ask an ordinary Chinese about the word bond, you know, the only thing they would say, oh, James Bond, yeah, because China did not have a financial market. But fast forward to now, China has a corporate bond market of $3 trillion. Now, just imagine how much investment finance has been intermediated between savings and private sector development. Another significant anniversary this year is the 20th anniversary of the Asian financial crisis. And before the Asian financial crisis, the emergent Asia operated on a model that is very similar to Africa right now, that is relying heavily on foreign investment. And most of the investment were denominated in dollars. And because of the momentum, you saw the four tigers, you saw a local currency appreciating, momentum gaining. So private entrepreneurs thought they got this figured out. They're going to borrow dollar with lower nominal interest rate. And when they pay 5-10 years later, you know, they're going to pay a much less burden because local currency would continue to appreciate. Boy, how wrong were they, right? Because at the financial crisis onset, quite a number of the currency dropped over 100%. Many Asian companies went bankrupt. But what I would say is any crisis is an opportunity to make progress. And Asia took advantage of that crisis and said never again. And therefore, the governments, private sector, policymakers got together over the past 20 years, really made a difference in say, we must denominate our economy in our own currency. We have to develop a deep, liquid, open capital market, both domestically and regionally, so that we have an efficient way of intermediating our own savings between the savers, the supply funds, and also the entrepreneurs who need the fund. So let's take one country, for example. The country is called Malaysia. And I just had a conversation with Governor Zati of Bank Nagara in Tokyo. And so she told me very proudly that Malaysia now has a corporate bond market that is 100% of the GDP from a single digit of GDP more than 20 years ago. Just imagine the progress that was made. You know, that got me thinking, if Malaysia could do it, Kenya could do it, Nigeria could do it, Zambia could do it. So in Africa today, we're still looking at, outside of South Africa, corporate bond in lower single digit of GDP. Therefore, there is tremendous room to grow. Now, the message has to be, we will continue to welcome international investors denominated in dollar, in euro, in Chinese yuan. But I think at the same time, there has to be a concerted effort to develop a vibrant, deep, liquid capital market with a size that will grow in importance.
The natural question that then comes to me is the focus on the how. How do we move from a James Bond moment to an investment bond moment in Africa?
Okay, let me mention three things.
Okay.
Yeah? The first is national leaders and policymakers have to recognize that capital market or financial infrastructure is as important as social infrastructure and physical infrastructure, right? So how can leaders in Africa take a long view on the development trajectory? That is, short term you can rely on economic momentum attracting foreign investment. But in medium to long view, how can we develop a domestic financial system that is robust, that is big enough to build resilience? Yeah. So recognizing financial markets' importance alongside that of physical infrastructure, social infrastructure. And that, I think, is more or less all done. That is, wherever I go talking to finance minister, central bank governor, head of security exchanges, they do recognize the importance. The second is regulatory framework.
Right.
That is, you have to have a set of regulations and market infrastructure that will support the build-up of broad instruments that a financial market needs. Now, when you talk about broad market, you certainly need to have a sound banking system that is a foundation of any financial infrastructure. But beyond the banking system, you need to have the whole spectrum of capital market instruments, from equity, debt, derivative, forward, future, commodity, so on and so forth. And that would complete that market infrastructure. And the third is you need to have market leaders and pioneers who will be the first one who tap the market, who show the rest of the potential issuers and investors that the market is ready. And this is where IFC can play this catalytic role, right? So in 2012, we set up this Pan-Africa Domestic MTN program with the goal of using a set of documentation that is internationally accepted, then start to issue bonds in the domestic market. So far, we have been successful in Zambia, in Namibia, in Rwanda. We are working with many other countries like Kenya, Ghana, Nigeria. So hopefully we, as a AAA issuer, once we're able to tap the domestic market, that will send a strong signal. Okay, as an international AAA, we are very careful where we issue. The fact that we issued is a stamp of approval that the market infrastructure. Exactly.
And as we begin to wrap up our conversation, I'd be really keen to understand which African markets are you really excited about in terms of the steps that they're taking, whether it be through reform, whether it be through investments in technology, or just pivoting the way that they're seeing capital markets. African markets that you think these are the markets that we need to be looking out for, because their capital markets are going to be deeper, they're going to be broader, and we're going to see some exciting things happening in this space. And maybe forget about South Africa, knowing that they're just a little bit out of the picture, but where are the new opportunities?
Yeah, I think in sub-Saharan Africa, let me mention three markets. Each of them, in my mind, would be similar to what India and China would be to Asia. Yeah, very important. In East Africa, certainly Kenya anchors the East Africa market, and through the East Africa community can play a much bigger role. In West Africa, you have Nigeria that certainly has a size, and then you have the West Africa CFA zone that has the size and the depth of market potential. In all three places, I think regulatory framework and market infrastructure are already in place. And now I think we need to call on players to come to the market to actually issue. Give you one example. In Nigeria, the pension industry has 6 trillion naira savings. And they have a new plan to extend pension to micro pension scheme that potentially will double that to 12 trillion naira. So there is a supply pool there. But meanwhile, the corporate bond issuance is is not active, right? You could see a couple of corporate bond issuance every year. So how can we as IFC, our peers like African Bank, our friends from KfW, we as an international community with our AAA rating, we should be some of the first ones who could go there and send a signal. The second would be we should support credit-worthy local players, right? Because at the beginning, people just want to buy high credit quality names. And their credit quality may be just at the margin. And we could use our credit to enhance their credibility, and we can, through our anchor investment, buy a portion of the bond. So we now need actions from market players.
And that would assume that we need to get even closer to the market, so you understand which players are not just relying on brand, but are really connected to what is happening on the ground.
Absolutely. Those have to be practitioners. Practitioners, both from the regulators, that would be Securities Exchange or Capital Market Authority, but the pension fund, the commercial banks who has access to liquidity beyond buying their treasury bills. If we can encourage them to be deliberate in supporting corporate bond market development and secondary market trading. The stock exchanges, in addition to equity, how they can also support the listing of a corporate bond. And also credit rating agencies, whether they are international or domestic, come much more granular in terms of educating investors about the credit differentials, in analyzing the risk-return combination. But last, certainly not the least, let me not to forget the $40 trillion of OECD money sitting earning very little, negative, zero, or low interest rate, right? Some of them are interested in buy local currency denominated bond. We have seen it because IFC over the past 3 years, for example, just take Indian rupee, we have issued over $2 billion worth of Indian rupee masala bond out of London and Singapore. And they have been selling like hot cakes, right? And we have repatriated 100% of our masala bond denominated in Indian rupee onshore, supporting infrastructure, supporting green financing.
And yet
while
the infrastructure need here is so great.
Exactly. So we could do the same thing. We certainly can repeat the successes that we have been experiencing in Latin America, in Asia, and hopefully we can do it in a much more accelerated fashion in Africa.
It's been a really robust conversation, sitting down with the Vice President and Treasurer at the IFC, Jingdong Hua, joining me here in Kenya at the Capital Markets Africa conversation happening in Nairobi. I'm Nozipho Mbanjwa for CNBC Africa. It's goodbye.